$35 trillion. That is the approximate size of the United States national debt today, a number so large that it's difficult to even visualize. Yet behind that number lies one of the most important structural questions facing the global economy in 2026. How sustainable is this level of debt? For decades, the United States has operated with expanding fiscal deficits. Government spending has consistently exceeded tax revenues, and the gap has been financed through Treasury bonds purchased by investors, institutions, pension funds, foreign governments, and the Federal Reserve. For many years, this system worked smoothly. Interest rates were historically low, the global demand for U.S. Treasuries remained strong, and economic growth allowed the debt to expand without immediate stress. But the environment has changed. Interest rates are no longer near zero. In fact, policy rates moved above 5% during the tightening cycle. That dramatically increases the cost of servicing existing debt. In simple terms, when interest rates rise, the government must pay more to refinance maturing bonds. The U.S. Treasury rolls over trillions of dollars of debt every year. When those bonds are replaced at higher rates, the interest burden increases rapidly. Some estimates suggest that annual interest payments are approaching $1 trillion. That means a significant portion of federal spending is now dedicated simply to servicing existing obligations rather than funding new investment or programs. But the debt story is not just about size. It's about the relationship between debt, growth, and confidence. Economies can sustain large debt loads if economic growth remains strong. Growth increases tax revenues and keeps the debt-to-GDP ratio manageable. However, if economic growth slows while debt continues expanding, the balance becomes more fragile. That is why analysts are watching the interaction between three key variables: economic growth, interest rates, and fiscal deficits. If growth weakens while interest costs rise, fiscal flexibility narrows. Markets pay attention to this dynamic. Investors purchase U.S. Treasuries because they are considered one of the safest assets in the world. The stability of the U.S. financial system, the depth of Treasury markets, and the role of the dollar as a global reserve currency all support that demand. But confidence is not static. It depends on credibility. The United States still has extraordinary advantages in global finance, yet the trajectory of public debt raises questions about how fiscal policy may evolve over the next decade. This does not mean an imminent crisis. Historically, large economies can operate with high debt levels for extended periods, but it does mean the margin for policy error becomes smaller. $35 trillion is not just a number. It is a signal of how dramatically fiscal expansion has reshaped the economic landscape, and understanding that shift is essential for interpreting what may come next in the global financial system. The United States national debt has now crossed approximately $35 trillion. To understand why this number matters, we need to look beyond the headline and examine how the debt actually functions within the economy. Government debt grows when federal spending exceeds tax revenues. That gap, known as the fiscal deficit, must be financed by issuing Treasury securities. These securities are purchased by a wide range of buyers: domestic investors, banks, pension funds, insurance companies, foreign central banks, and global institutions. For decades, demand for U.S. Treasuries has been extremely strong. They're considered highly liquid and relatively safe assets, forming the backbone of global financial markets. But in recent years, the structure of the debt has changed in important ways. One of the most significant shifts involves interest rates. During the 2010s, interest rates remained near historical lows. The U.S. government could borrow at extremely low costs, which made expanding debt more manageable. However, inflation pressures forced the Federal Reserve to raise interest rates aggressively. As a result, new Treasury bonds are now issued at much higher yields. This creates a compounding effect. Even if the government stops expanding spending dramatically, the cost of servicing existing debt increases as bonds mature and are refinanced at higher rates. This process is sometimes described as the interest rate snowball. The larger the debt becomes, the more sensitive the system becomes to changes in borrowing costs. In practical terms, this means a growing share of the federal budget goes toward interest payments. That reduces fiscal flexibility. Resources that might otherwise be directed toward infrastructure, research, or economic development must instead be allocated to debt servicing. From a market perspective, this dynamic matters because it influences investor expectations. If investors believe debt growth is manageable and supported by economic expansion, Treasury markets remain stable. But if investors begin questioning long-term fiscal sustainability, they may demand higher yields to compensate for perceived risk. Higher yields then increase borrowing costs further. This is why analysts focus not just on the size of debt, but on its trajectory. $35 trillion is historically unprecedented for the United States. Yet the critical question is not simply how large the debt is today. The real question is how quickly it continues to grow relative to the economy itself. That relationship will determine whether the debt remains manageable or becomes a defining economic challenge in the years ahead.
$35 trillion in national debt raises an obvious question. What does it actually mean for the economy, markets, and the future of fiscal policy? The answer begins with understanding the role of debt in economic growth. Governments often borrow to finance investments that stimulate the economy. Infrastructure projects, technological development, education, and emergency spending can all be funded through borrowing. In that sense, debt itself is not inherently negative. What matters is whether the borrowed funds contribute to economic expansion. If the economy grows faster than the debt burden remains manageable. But when debt expands faster than economic output, the balance gradually shifts. The United States now faces that challenge. Over the past decade, fiscal spending increased significantly during major economic disruptions. While those policies helped stabilize the economy, they also accelerated the pace of debt accumulation. Today, the national debt is larger than the entire annual output of the U.S. economy. This is known as the debt-to-GDP ratio. Historically, elevated debt-to-GDP ratios limit policy flexibility during future crises. Governments with high debt burdens may find it more difficult to respond aggressively to recessions or financial shocks. Another important factor is the global role of the U.S. dollar. Because the dollar functions as the world's primary reserve currency, global investors continue to hold large amounts of U.S. Treasury securities. This creates sustained demand that helps finance government borrowing. However, global financial conditions evolve. Geopolitical shifts, changing trade patterns, and diversification by foreign central banks all influence Treasury demand. Even small adjustments in global capital flows can affect borrowing costs. That is why the national debt discussion is increasingly connected to broader geopolitical and monetary dynamics. Markets will ultimately determine how comfortable investors remain with rising debt levels. So far, the United States retains a remarkable ability to finance its obligations. But as the debt approaches $35 trillion, the conversation is shifting from short-term financing toward long-term sustainability. Debt levels alone do not determine economic outcomes. Policy decisions, growth trends, and global financial confidence will shape what happens next, and those forces will define how the world's largest economy navigates the decade ahead.